space has changed.
Yeah.
And we've used a lot of the data from the digital technology that we put into the space to justify that. So I do think there'll be more kind of creative thinking about how people occupy space.
Desk rates are competitive, but again, it's become more focused around core locations, close to stations. I think if you go out to, again, some of those peripheral markets around central London where serviced office providers have got space, I think they're struggling.
Welcome back to Property Perspectives. I'm your host, Ashley Toy. I'm joined on this series by Tom Sharman, our Head of Research and Strategy. And today we have John and James in from JLL. Welcome, guys. I think today's episode will be talking about office, but start with John, a bit of a background and where you got to for here.
Thank you very much for having us. John Woodger. I lead the City Capital Markets team for JLL. I've been at JLL for nearly 16 years now, started as a graduate and spent most of my time working in the central London market. I've spent some time working overseas for the business as well, but sort of back in London and I've focused there for the last sort of 10, 12 years since being away.
So I'm trying to count back 16 years, John. Where does that take you to?
Just coming out of the GX, it was 09. So an interesting time to get a graduate job, but we sort of saw the worst of it, and then things start to recover, and that sort of equipped us all for the change in the sort of end of the last cycle and the sort of bottoming out of the market and the re-emergence that we're starting to see now, which is all encouraging.
Definitely.
Indeed.
Yeah, so James Devany, I lead the office leasing and occupier advisory services up in Manchester. So I've been at JLL 11 years.
Yeah.
I work across kind of Manchester, but closely linked up with our regional teams across the big regional cities. And then prior to that, as we were discussing earlier, I was at Popco Bruntwood in Manchester for about 5 years, which was, great insight into the stuff that those guys do and do well. And then prior to that, you might guess from the accent, it's Northeast. So 5 years over in the Northeast working for a consultancy, Sanderson Weatherall over there. So that's my background.
Excellent. Yeah, we wouldn't have got it from the accent. Helpful, you, Clay.
How much has Manchester changed in the time that you've been there?
Unbelievably so. So I came across in 2010, and I would say the city is unrecognisable in some way, in a really positive way. The amount, you could just look at the southern part of the city, Deansgate Square, the skyscrapers there. Some people call the Manchester Dubai. So it's just changed hugely. That's because of the amount of inward investment we've seen into the city, people living in the city now. Pandemic has probably got a little bit to do that. We had just anecdotally, we've got friends nearby us that have moved up from London. Made that change, decided to get out of London and come up to the northwest, just Manchester's had a real kind of strong last 5 to 10 years.
I think a lot of places can learn from Manchester, I think, in the way that they've kind of driven growth.
So I guess if you take that out to the broader big cities, then how does it compare and contrast at the moment?
Yeah, at the moment, the big six cities from an occupational side, we look at take-up. And looking back over the last couple of years, we've seen pretty robust take-up. Manchester, not wanting to focus too heavily on Manchester, but it does lead the way in comparison to the other cities. But even still, you're seeing kind of good levels of take-up and from Bristol and Birmingham and Edinburgh. So I think where we're at now is that where a lot of those cities have seen good levels of supply, the issue we've got now is this constrained level of supply due to lack of kind of or challenges around viability to bring forward new schemes.
But the constrained level of supply in a relatively, so in the better, more modern stock, right? So I'm not sure whether this is true of Manchester, but kind of more broadly of the regional markets, you have this kind of dichotomy of quite a lot of overall supply, but very little as the kind of modern.
So the best way to evidence that in Manchester is if you looked at overall vacancy, depending on which numbers you look at, but if you look at our numbers, you're at around kind of 9 to 10% overall. But if you look at best in class, new build, you're still 1%.
Are those dynamics the same in London? I get the sense, from a kind of generalist perspective, which is my perspective, that London is slightly ahead in terms of investment market liquidity. So there's a little bit more kind of activity coming in, but from a supply perspective, is it the same picture as
Well, the numbers are the same. I mean, overall vacancy for London, including everything, is just below 9, so 8.9. And then new build or significantly refurbished is 1.2%. So almost spot on. So I think the dynamics are absolutely the same. I think that the development equation, the viability is still really challenging, even when we're talking about West End rents at 200 plus, city rents getting to 100 plus now. Even with those rents, I guess we've seen such a change in the cost environment, the cap rate environment, the financing environment, that those three elements sort of pointing in the wrong direction, or having pointed in the wrong direction for the last, let's call it 3 years. The rental side is not enough to to support that sort of decision around should we go and build.
Okay, so the things I read in the press, that you see this rent £104 in the city, or 100 and whatever it may be, and you think, okay, that's for somebody who remembers when 60 seemed to be a ceiling.
Yeah,
that seems pretty staggering. Presumably those rents are being achieved in schemes that the spade first went into the ground in 2019. And you're kind of now seeing those come to market. So presumably, is there then, are there more schemes coming through in the pipeline over the next couple of years, or are we going to really hit a kind of a hole?
I think we'd love to hit a hole, in the sense we'd love to see more holes being dug and more buildings being built. I think we see that new build supply, that 1.2, trending downwards. Because there have not been enough development starts. A lot of the space that is coming out of the ground is already pre-leased. If you think about last year, British Land and 2 Finsbury Avenue, Citadel taking that that huge pre-let. We've just seen Herbert Smith sign at Broadgate. That building that's a major refurbishment. That building is yet to start.
So I didn't recognise the picture when I saw it.
No, exactly. It looks slightly different to what the building that sits there today. But they are pretty much truly off-plan pre-lets, and we're going to start to see more of that. So the pipeline that's coming through and being delivered, a lot of the space is never hitting the market because it's already been absorbed by the pre-let market. And we've got, I think we've got over 20 requirements in the market over 100,000 square feet across London. Okay. So there is significant pressure on the pipeline. The change that we saw last year, and I think we'll see that theme, and it's one of our sort of predictions for this year, is the loosening of the pipeline. And as we know, real estate, development takes a long time to get built, planning, just the pure delivery of these schemes. But we saw a couple of development schemes change hands last year, i.e. fresh capital coming in, either purchasing sites or capital coming in on a kind of joint venture basis. And you've got to believe that by recapitalising those assets or selling those sites, that those schemes then get pushed through and commenced. Some occupiers are really afraid of signing rents so high at the moment. What we're seeing is a lot more partnership between occupiers and landlords, and how can we make this work for both parties? Yeah. You need a new building. We need to go and build it for you. It's got to give us a certain level of return. So we're also seeing, in order for the cap rate piece of the equation to work, we're seeing leases get longer again.
Okay.
So a lot of these pre-let deals now are minimum 15 years, and some are pushing to 20. We're seeing first rent reviews having some form of fixed uplift, guaranteed, some form of guaranteed income performance. One of the other reasons that leases are going out is fit-out costs have become so high, so tenants need that time to amortise those fit-out costs. Okay. So if you remember pre-COVID, and when WeWork was doing its thing and the disruption of the market was going on from a sort of leasing perspective, leases were getting shorter, everyone wanted more flexibility. I think the flexibility point is still important. Yeah. So we're seeing on these pre-lets, you might sign a 20-year pre-let, but maybe some of the space will have, some of the floors will have break options in them. But for landlords, it means that they can start to tweak the development equation so that they are motivated to go and build, and everything doesn't have to go through the rents. But as I said earlier, financing costs are moderating, and I'd say more than moderating, coming in pretty quickly. Yeah. Margins are squeezed, even for spec development.
So on the you mentioned there sometimes the kind of fixed uplifts on 5 years. So that effectively, I guess, to a certain extent, gets around the upward only rent review challenge.
Yeah.
Or the lack of thereof.
Yeah, and I mean, I don't know about you, it was announced, it was a bit of a shock when it was announced. It was sort of debated. It's all obviously gone quiet and is sort of going through the system. I think there's a general consensus view that it's unlikely to happen,
Okay.
and a one size fits all.
Okay.
And that's not a house view, but that's a sort of general market view. I think.
It's the feeling I think.
Yeah, and it's not. I think it suits certain other sectors, but I think the office sector it certainly doesn't suit.
Yeah, it was dressed up. I can't remember the name of the bill, but it was very much kind of dressed up as high street, wasn't it? So I think that's what they had in mind, isn't it, when they were thinking of it.
Yeah. I think there's enough other headwinds in the market for people to worry about that. And we've seen no. Normally, when those things get announced as a shot, things come in without people expecting them. You generally see deals wobble or stall, or when Trump's tariffs came in last year, we saw a few deals sort of get paused and go back to investment committee, and they ended up getting done. But around the rent review point, we've saw nothing halt.
Yeah. The irony really is in high streets, typically you don't get to the point where there's a rent review, do you? Leases will typically be 5 years.
Yeah.
So I guess just thinking about a lot of the stuff we've talked about there is de-risking from both sides of the equation, but also rents kind of continue to push to make things viable. Does that change, I guess, occupier focus? So do you think people will start moving to slightly alternative areas?
Yeah, it's an interesting question. And it kind of everything that John's just said is relevant to the regions, just in on a different scale from that supply demand, where the rents are going. I do feel that in Manchester and across the Big Six, the next new builds that will come forward and be delivered will be 55 to 60 quid a square foot, which is quite a big jump from where the rents are currently at 40.
Where they're mid 40s, yeah.
45, yeah. So 45, maybe over the next 6 months we'll see 48. Might be a pre-let drop in this year that could end up being 55 to 60. So there's quite a big jump there.
Yeah.
Now the conversations that we're having on the occupier side, those questions are coming up around, wow, that's a significant jump from where we are.
Yeah.
The conversation then about re-gears comes in.
Yep.
But then the suitability of the building and the specification of the building they're in comes up for debate, and the modernisation of that building that they may need, especially if you're a big corporate and you have to hit some of these sustainability targets that are scientific targets that big corporates have signed up to. However, I get the impression, or we get the feeling from the corporates that we're speaking to them with some big lease events that are coming up, that they appreciate that that's just going to have to be a fact of life if they want to be in the best quality building, if they want that kind of retention, recruitment, draw and pull, and that they need to hit those scientific targets.
If you make the decision to move with all the costs inherent in that, and you know, what element do you compromise on? As you say, you want to have the building fit for modern working practices. You equally want to be in a location where you've got all the amenities around, so your workforce is, wants to come in and wants to work for you. So you can't really compromise on spec, and you can't really compromise on location. So as you say, sometimes you kick the can down the road and just re-gear where you are. How about refurbs? So again, from a kind of generalist perspective, I look at it and say, okay, if you need £55 in Manchester to build from the ground up, what do you need, or can it work to do a full kind of refurb, or is it just as expensive?
What kind of large-scale brown to green refurbishments we refer them to? The rents aren't that far behind. So there is a discount, but again, some of the interventions that you're seeing on some of these significant assets, it means that the capex is big. We're working on a couple of buildings in the city at the moment, in Manchester, where you're seeing some quite chunky numbers come back. But I think, especially if you can get your hands on something that perhaps is close to being VP, then I think there's an opportunity there. Look, it feels like in that refurbished end of the market, if you're delivering something with all the bells and whistles you would expect, what's a discount? You may be, instead of 55 to 60, you might be 45 to 55 or something like that. That's perhaps the differential, but you're still getting a really great product.
Yeah, but it feels like the raw material of buying an older asset with short income should be relatively cheap.
Yeah.
But the cost of getting from A to B is obviously the restrictive factor. So we look at things obviously when you see institutional buyers or kind of corporate tenants, they probably want BREEAM excellent or outstanding or one of these really kind of, but perhaps other occupiers may be more content with something that is less, less expensive to get to. So is there a demand for that kind of next notch down of stock?
I'm definitely seeing a change in viewpoint on sustainability from a sustainability perspective, perhaps driven by the Dom we discussed before, and the Americans, and just some of those American corporates that we're dealing with just have a totally different view on sustainability in the pecking order of kind of what an occupier would like to see. Has definitely moved down. There's JLL do an impact survey of a number of kind of occupiers internationally, and it's probably dropped down to number 4 or 5 in the list now. And location, security, interesting. That's probably driven by some of those American organisations, banking, etc. Is kind of up there. So it's definitely dropped off. However, a lot of these corporates have still signed up to scientific targets. And, I mean, look, honest opinion. I think if you're hitting BREEAM in operation and neighbours feels like the kind of the best kind of solution at the moment, but BREEAM are also looking at bringing in kind of an operational carbon assessment process. Those things, you're fully electric, and you're delivering a building, whether it's refurbed or to my view, kind of is doing a lot there. I think, and I don't think that would impact your leasing strategy if you weren't, let's say, collecting some of these badges that are out there. I think you need to dig beneath the surface and to kind of really get into the skin of it and see what's important to occupy.
You touched on sorry, Ash.
It's all right, you go.
You touched on location. It just made me think about location. When I started out in real estate, the central London or the city office market was very much in a certain postcode district, and that's you wanted to be within a certain distance of bank or wherever it was. Now it feels to me like there's other criteria that are less about traditional core and more about amenity. So in central London, is there a move perhaps away or expanding away from some of these kind of traditional cores?
I think the core's shifted north because of the Elizabeth line. Certainly speaking for the city, you've gone from that sort of the clustering around Bank of England, that is still the historic core. But I think in terms of talking to occupiers and the investment market, they would like to be closer up towards Liverpool Street. And actually, if you look at the rental performance of assets within a certain walking distance of the Crossrail Elizabeth line stations, there is meaningful differential. So that's flowing through to value on both on the rental side and ultimately on the kind of liquidity capital side. So I think it's shifted. And if you go across to the West End, there's a lot of development going on around Bond Street Tube Station, Tottenham Court Road. So I think the core has shifted up. I guess the West End still has its garden squares of Mayfair, where you're always going to see private capital chasing assets. You're going to see the hedge funds, the big private equity businesses who just want to be on those garden squares. So I think the West End is slightly more nuanced from where the core is, but the city certainly we've seen sort of from Moorgate up towards Liverpool Street and Broadgate is where there is the real clustering effect. I think to sort of go back to the question that James dodged around what will happen, those markets that I guess where the post-COVID the tide has gone out a little bit in some of those peripheral markets that were performing so strongly going into COVID. I'm talking Shoreditch, the South Bank, Aldgate. They were from both a leasing and from the capital side. They were in vogue, and investors and occupiers wanted to be in those locations. Things have changed a little bit. I think a lot of occupiers have retreated to the new core, and therefore we've seen some of those markets suffer a little bit. Certainly up that eastern corridor of kind of Aldgate, Whitechapel, around there. But what we are now seeing is sort of backfill demand from investors wanting to do change of use, investors and developers wanting to buy offices and change to other uses somewhere in the beds world, from hotels to co-living to student accommodation. So I think we're fortunate, and again, talking to colleagues globally, that this is not a London phenomenon, it's a UK, it's a global phenomenon. We have too much office space, but thankfully, certainly the likes of the City Corporation, Southwark have been really pro. They've got onto it early. They've spotted that they've got too much office inventory. And they've also recognised that amenity, a mix of uses, is actually a positive thing. Whereas wind back not that long ago, the City Corporation's planning department was very much about this is a place for business. And hotels and all those things can operate in little pockets, but we're not going to have hotels in the middle of the city. But your old building at Princes Street, that is going to be a hotel overlooking Bank Junction. And so I think the city, it's got a long way to go, but I think it's going to become a bit more like the West End in the sense you're going to have this sort of collision of different uses, which from my perspective is only a good thing for both all of us as kind of office attendees, people coming to the city at the weekend, not just Monday to Friday.
I was going to say Monday to Thursday, really. It's almost like the weekend now is 3 days, and in terms of making use of the kind of infrastructure in the city, isn't it?
Yeah, if we've got this far and not talk about occupancy. So I mean, it'd be really helpful to just go, I guess, touch on occupancy, and we're kind of moving into like what a good asset looks like and where the challenge ones look like as well.
Yeah, I mean, just kind of moving. I mean, this percentage is here, but just interesting to hear what John was saying there about London and the geographies of that, because there are similarities with the regions. It's just on a different scale again. That you're looking at the city cores of Manchester, Birmingham, etc. And then if you look at those kind of regional out-town markets, that's where you're seeing what's happening on those more peripheral kind of areas of London. So especially in Manchester, where you've got historically there's been quite a strong regional market with South Manchester, Warrington, etc., the peripheries of the city. What we've seen in the last 5 years is significant movement of those businesses based there into the city centre.
Yes.
And that's recruitment and retention of talent.
But maybe in areas that weren't the traditional city office core in the city centre. So you got
exactly. So you've got Manchester's quite tight knit city with the CBD, spinning fields, but now we're seeing what perhaps were regarded as peripheral scheme are now part of the core, which is the likes of the Circle Squares of this world, the New Baileys, the Nomas. They are part of the city now. So it's the areas outside of the city that are suffering. So the business parks, that's where there's real head scratching going on. The best ones do seem to be still performing where they're investing in amenity, and that is positive. But there are some others that are struggling, and you may see change of uses with those kind of those buildings.
That's interesting differentials, I guess. If I'm hearing it right, a flight to quality is happening in London, but your quality area is broadening in Manchester. The area that people will go to.
Yeah, I think so. And why has that happened? Perhaps maybe some of those buildings within the historic centre of the city, the sites are more constrained, therefore you can have smaller floor plates. A lot of the larger occupiers want larger floor plates, so that's perhaps why some of those other schemes have performed well. I think on the occupancy side, linking that in, I do think that out of town, we've definitely had conversations with occupiers who've moved in because they're struggling with occupancy. But if they can be in the city and they can give people a reason to be in probably 4 days a week, maybe not 5, because then that's happening, I think, and those moves. Look, I think the other piece is there's definitely a move for a higher presence in the office. We're seeing that.
I think there's no perfect data set to tell you. There's the TfL tap-ins. I prefer the sort of the press index and the chatting to the bloke or lady who serves you coffee in the morning about who's coming through the door.
They know, don't they? They
know, and I think it's encouraging. And being a city guy, it's encouraging to see lots of new restaurants opening, coffee shops opening. Brands. It's a brand called Roslin. They're opening multiple in the city. And it wasn't that long ago talking to one of the main guys there that they were really struggling because they were saying, we cannot run our business. Rent is a 7-day payment, and we're getting 3 days of trade. I think that 3 has certainly become 4. Mondays feel busier just coming out the tube and the train stations. Yes, Fridays are more difficult. But the other sort of anecdotal piece is occupiers who signed leases during COVID. Thinking about how do we shrink our rent bill, how do we shrink our footprint, and there's an example of Aviva who moved from the Aviva Tower into a building on Fenchurch Street, and they were very pleased with what happened coming out of COVID. But actually now with everyone coming back to the office, they do not have enough space in that building, and that building is now fully let with other occupiers. So there's anything that comes up within the building, there's a space race, and then also they're probably having to look around the periphery, and that's just one example. There's many others.
Well, we certainly, we kind of recognise that lived experience in the sense that Tuesday to Thursday is as busy as it ever was.
Yeah.
In fact, probably more busy because we're compressed into a smaller space. But so even if we allow for the fact that Friday is even quieter than it used to be, and Monday is slightly quieter than it used to be, you still need the same amount of space for Tuesday, Wednesday, and Thursday.
Yeah. Exactly.
And that's probably the realisation that's coming through. You can't, if everyone is in for those 3 days a week, you can't save any space.
No.
So how longer term, I suppose, I think about pre-COVID when we used to get on conference calls and there was no video, it was just on the call. Half the time you had no idea who was speaking. Multiple people trying to speak at the same time. It was disastrous. You think, we don't all love conference calls now, but they are a lot better than they used to be. So I guess, leaping kind of 10, 20 years ahead, you think if video conferencing technology has got even better and even more natural and fluid, how do offices kind of adapt to the kind of the changes? And I'm of the view that people will always want to come in and meet in offices. So I'm always of the view that we will need offices, but how do they change and how do they adapt to reflect the different kind of requirements?
I think we're seeing that materialise in more detailed workplace planning now. So engaging, having a steering group that engages with a workplace planning team. Our guys are doing a lot of that at the moment, trying to future-proof the space.
Yeah.
So, I mean, our space in Manchester is a great example. We that was delivered for 2020. We're due to move in when lockdown happened. So it sat there empty for 12 months, and then we kind of moved in. But I'd love to say it was purely by design, but I think there's a bit of luck there as well. But the space has changed.
Yeah.
And we've used a lot of the data from the digital technology that we put into the space to justify that. Right. So using data to track that, and then changing spaces in the office to suit those needs. So, for example, the Zoom booths that we had are more readily used. So we installed some more. We were able to do that because the way we've created the space. So I do think there'll be more kind of creative thinking about how people occupy space. And as you said, John, we've seen that example of occupiers that have taken space in 2020 that hasn't been quite right. Yep. And I think because of that that lesson, I'm sure they'll look more closely about how they move forward because, in 10 years' time, things will probably be in a very different place. But difficult. It's crystal ball gazing, but I think there's an element of kind of strategy that can be applied to that.
I think it's interesting, John, you already kind of touched on having to sign longer leases because of the cost of or because of, having to pre-let and the cost of development, etc. But building in that flexibility of having some floors so that you can flex in and out of that. Yeah. How does the flexible office world with a capital F, the kind of serviced office world, how does that fit into the whole picture?
Well, it's sort of gone through almost a mini cycle, hasn't it? I guess we talked about earlier. Sort of, it was all getting quite overheated in that world pre-COVID. By its own design, it got hit very hard through COVID because people could just sort of hand their agreements back and the revenue stopped flowing. It sort of feels like we've now. I'll be interested in your view, James, but it's right-sized. I think a lot of the centres are performing a lot better. I think the operators are a lot more cautious about what they sign themselves up to. There's a lot more management agreements, which is a bit of a dirty world on the capital side about how you price those and will investors attribute value to to those agreements. Okay. But I think from the sort of pure operational side, they've got a place in the world. We're seeing in some of the larger buildings where landlords will bring in some of those providers to provide amenity space that they have to provide under the core leases in the buildings. So I think it feels like that cycle has sort of weeded out that hyper growth that ultimately all sectors go through at some point. But it feels like it's settled down again. Desk rates are competitive, but again, it's become more focused around core locations, close to stations. I think if you go out to, again, some of those peripheral markets around central London where serviced office providers have got space, I think they're struggling. Yeah. And in some cases, WeWork have handed keys back, or other operators have unfortunately had to sort of fold leases. So I think it's gone through a cycle. It's definitely more mature, but it feels like it has a place in the world. I think it just doesn't always get fully understood or fully valued from the investor side of things.
We've been talking for a bit, but we haven't talked about AI like that yet, which is incredible. We've been talking about this long. So I guess as a broad question, how do you see AI impacting your industries? You can go first, John.
I guess it's sort of multifaceted, isn't it, in terms of the use of it within our business. We are using it. We've been, as a global business, we've invested heavily in technology and AI, and we've got particular things at our fingertips, which are real enablers and are making us more productive, more efficient. If I sort of step out of JLL and just look at the market, yes, it's disrupting, and it's disrupting at a rapid pace. And we sit here 2 weeks after the sort of market turmoil that was created by it, talking to our tenant rep team in the last week around, have they seen anything anything in those discussions to indicate that it's going to disrupt heavily? I think some occupiers who are in the market at the moment looking have certainly mentioned in the last couple of weeks around more flexibility. Might they want the ability to pre-let, but be able to drop more space before PC or sometime during that lease? Because if AI is going to have a real impact on bodies and use of offices, then you don't want to be saddled with a long lease on a building that's too large. But I think it's very early to judge what the impact is.
The developer wants some serious compensation for that, for offering up that get out clause.
And I think everyone's just coming to terms with how can we use it as an enabler, but what potential negative impact. But the other positive is we're starting to see some really strong demand from the AI businesses, or businesses that are using AI and technology. We've seen Anthropic, we've seen OpenAI go from very small footprints to take much larger footprints in London. So we're definitely going to get some replacement demand coming from that subsector of technology.
But what's happening in London, I think we'd like to see some of that action in Manchester as well. There's some great schemes up in Manchester around the Oxford Road corridor and universities where AI is a real focus, and you've got some sort of small SMEs there that are growing rapidly. And hopefully, not just in the future, we might see some of that AI action in London happening in Manchester as well.
Back to offices, it was a swear word for a while. I think the sort of curiosity sort of started to come in last year. You saw the first movers of private equity, and we're now starting to see the institutional capital come back into offices, and offices of scale. We saw Norges do their first ever deal in the city of nearly 300 million. That's a real shot in the arm for the city, for London. It's institutional capital, and it's the type of investor that others will recognise, and they've almost got that sort of magnetic effect if they'll pull in others. And actually, the UK funds are looking at London offices again. You've got all the main houses looking, because they're looking at the relative value and the relative returns across the sectors they can invest in.
So the bull market starts here.
But, guys, we've been talking for ages. I think we could talk for a lot longer. Conscious that you guys have got jobs to go and do. So I really appreciate you coming in. Thank you very much.
Thank you for having us.
Thanks. That's been it for another episode of Property Perspectives. If you've enjoyed, please click like and subscribe.